Hey everyone, welcome to another week live with Caeli. Today is June 28th, 2022. And as always, we want to welcome our host and sponsor, Ridge Lending Group. Always join us here every Tuesday from 4:30 p.m. Eastern, 1:30 p.m. Pacific. And we go until you're done. Sometimes it's a half an hour, sometimes it's longer. It just depends on who's asking what questions. And speaking of which, today's topic, we are going to be covering, Caeli's going to help you really focus in on when and how you should be reviewing your real estate portfolio, covering some ideas on how to make it grow, different perspectives. That dovetails into thinking about what loan programs are available and loan programs you should be thinking about. And that kind of dovetails into the Ridge Lending Group Certified Power Buyer Program, what that's all about. And then at the end here, we'll cover open Q&A. So if you have any questions at any time during this entire meeting today, feel free to either use the chat box on the Zoom, or feel free to take yourself off mute and go ahead and ask the question as you have them. And we'd love to begin here. Caeli, welcome, and thank you very much for joining us today.
Good afternoon, everyone. As always, I'm so impressed with your continued desire to want to learn and inform yourselves, that you take your time out of the day. I know how busy everybody is. Just speaks to your level of commitment on wanting to excel and thrive in real estate. So thank you for being here. I'm glad you continue to come back, because that means that we're providing some good content. So that's a win. Yeah, so we're going to talk about strategy, right? What does your real estate portfolio look like today? What do you want it to look like? How do you get there? I think that's going to be the broad strokes of what we're going to be discussing today. More often than not, I mean, we can certainly talk about those things. And if you have a portfolio, or even if you don't have a portfolio, how do you know what the next steps are? When you do know what the next steps are, maybe you have some deficiencies in some of the criteria to qualify. And what do we do with those, right? Maybe you're lacking the capital, right? What are some different ways or some creative ways in which we can gain extra capital so you can keep acquiring property? Maybe you've got credit issue. Maybe you've got assets that are a little bit low for reserves. Maybe your credit score isn't quite there. Whatever your situation is, we'll kind of pick at a few of them, give some examples or some ideas on them. And then, like Larry said, some Q&A. So Larry, did you say, you started by saying that we really just want to touch on when you have a portfolio or you're trying to gain a portfolio, how do you understand what your next steps are? Was that your first?
Yeah, I think, right. So this week we've seen a fair number of requests come through. You know, a lot of people email into info@ridgelendinggroup.com and they're like, hey, listen, I have this thought about what I'm doing with my real estate portfolio. And that thought could be, I'd love to get into real estate, or it could be, hey, we've got 15 properties. What should we do? I mean, literally, it can go from both ends of the spectrum. So I thought maybe if we took a stab, if anybody has any of those questions for yourself personally, as far as where you're at and where you'd like to get to, and picking Caeli's brain, so to speak, in terms of getting there. That's one way to get there, Caeli. So yeah. If anybody has any questions, feel free to use the chat, or feel free to take yourself off mute, whatever you're comfortable with. But if we kind of start at the beginning, Caeli, and you've got somebody who either is not an experienced real estate investor, or maybe hasn't invested in real estate in quite some time, maybe just some feedback on how to get back in the game, or how to start to get in the game.
Yeah, so I think that this would be true for somebody that has a portfolio, and even those that don't yet and are really just trying to break into real estate investing. I think it starts with your why, okay? Maybe that sounds a little bit trite, but you really want to understand what it is you're trying to accomplish with this. Are you looking at real estate as, for example, a full replacement of your current income? Are you looking at it as a supplementation of your current income? Maybe you love your job and you're always going to be doing it, and you just want to supplement using real estate as that means, or part of that means, so that you get to choose how much you work on a week or month or annual basis. So figuring out what it is that you want real estate to do for you is the first thing. And then more specifically, what does that number need to look like? You really need to kind of peel it back and look at it granularly, what does that need to mean monthly for you? What is that net monthly number? Once you've kind of identified that, then we can start working the math backwards, and we can figure out from there, based on what your qualifications are. I should probably go backwards. Once you figure out your why, you need to get pre-qualified, right? You have to apply, you've got to get your vials of blood, your DNA samples on file, all of that stuff, so that we can identify what your qualifications are today, match them with your goals, short-term, long-term, and then we'll come up with, we'll work it backwards and come up with what does that actually look like. We'll create, everyone's heard me say this ad nauseum, that roadmap that says, okay, over the next 12 months, based on what we have to work with, this is what we can do. And this is how we're going to start preparing for the 24 months after that, or the 5 years after that, and so on and so forth. So that's where you would start. And if you have a portfolio today, then similarly, we take a look at what your baseline is today, qualification wise, what you have to work with, where you want to go. And we'll just simply, one by one, check off the boxes and figure out, what does that mean for you? Are we harvesting cash over here? Are we going to look at getting into, the BRRRR strategy of real estate investing, the fix and flip of real estate investing? Maybe we want to start finding second lien HELOCs or something, so that you can grab equity that way. There's a whole slew of things that we can look at that will get you to that next level if you already have a substantial platform in which to go from. Beyond that, I would say that more often than not, I'll have clients come to me and say, well, this is where I want to be, but I'm stuck because I don't know how to get more capital. So I was thinking about this morning, and I took some notes. There's some other ways that might not just be obvious. So I'm just going to share some of that stuff, and you guys feel free to ask questions as they come up. So harvesting equity out of existing property is the most obvious one, right? If you have rental properties now, whether it be your primary residence or an investment property or a second home, it doesn't really matter. Harvesting that equity by either doing a cash out refinance or a HELOC, namely the all-in-one, which is a first lien HELOC. And if you don't want to mess with your first lien, you can look at a second lien HELOC. I've been telling people that the best sources for investment properties to check for second lien, Ridge does not do second lien HELOCs. We only do that first lien all-in-one, which, I would argue I'd mark up against a second lien HELOC any day, and it's going to beat its, but we can have that individual conversation. But if you really want that second lien HELOC and you don't want to mess with your first, again, I'd argue with you to look at the all-in-one. But beyond that, PenFed, PENFED, if you guys want to write that down, I would suggest you check with them for investment properties. Bank of the West, I don't know that they're in all 50 states, but Bank of the West also has second lien HELOCs for rental properties. And for your primary residence, the all-in-one is what I would suggest. But second lien, I think US Bank still has one. A lot of the banks have really pulled back on second lien HELOCs, so it may be a little bit trickier, but you can find them. You're just gonna have to dial for dollars. The other ways that you can look at harvesting or grabbing at capital, your retirement accounts, right? Take a loan out on your 401k if you've got one of those, anything like that. I'm gonna liquidate stock. Seed capital, I'm going to come back to that in a second. You guys could look at a joint venture. Maybe there's another investor out there that has a ton of capital that they want to use, but they don't have any income or they don't have any credit, right? Or their credit's really bad. They want to get into real estate. So subscribe to different forums, real estate blogs and things, and start talking to people within our community, obviously, right? You could probably find a joint venture in here where you've got the qualifications and the time to go out and vet the properties. And maybe you want to find somebody that's got the capital, and you come up with whatever equitable split on the cash flow, appreciation, tax benefit, right? Whatever that means. So joint venture would be another way. Seller financing. Now this one might be unique. This one's not one that comes up a lot. And most people don't think down or through this line of scenario for getting at capital. So if you're out there and you're looking at different markets, and there are very specific ways that you could look for seller financing, where you're going to go directly to the homeowner and you're going to try and get them to finance you to buy this property. So whatever their why is really what you want to find first. But if you can negotiate something where maybe you give them $5,000 cash to start, and then you're paying whatever every month, a portion of that will go toward the down payment. You need to make them put you on title. This will be very, very important. You have to be on title in order to do what I'm about to describe. So if you can negotiate some kind of seller financing, land sales contract, whatever, they put you on title. After 6 months or 12 months, you can refinance. It wouldn't be a purchase anymore because you've been on title. You've got that ownership. You can refinance, rate and term, pay off the seller. They're good, and now you've got your property, right? You didn't have to go. It gives you time either to build credit or to build reserves or whatever. So that might be another unique way or creative way to come up with capital. And then lastly, and this one's a little bit more complicated. This relays or it applies to the BRRRR method of real estate investing. For those of you that are not familiar with BRRRR, it stands for buy, rehab, rent, and refi. Okay, you can actually use unsecured lines of credit. These are basically credit cards is what they are, where you can get these introductory rates of 0 interest for 6 months or 12 months or whatever it is. Seed Capital is one company that I know that does this. They provide this service for investors. So if you qualify, I'll give you an example. Let's say that you can go and get $100,000 of interest, 0 interest for 12 months of this unsecured is key, lines of credit. So you buy a property that all in is $75,000. Okay, you draw down $75,000 of the 100 grand of the unsecured lines of credit that you qualified for. You go and you pay cash for this property, and then you come back to us and we will do a rate and term refinance. Or actually, no, I'm sorry, that would be a cash out refinance, but the cash is going to go to repay those lines of credit. As long as the, I guess, leverage that you're using, other people's money that you're using, is not a recorded lien on the property, we can do it under the delayed cash out refi rules, which does not require any seasoning. We can do it immediately. As soon as it's appraisal ready, we can utilize the delayed cash out refi rules, 75% on a single family residence of the appraised value. So let's say in my example, you paid $75,000 for this property and you utilize this 0 interest lines of credit, 75 grand. We go and get you a loan and the value comes in at 100,000. We give you a loan of 75% of that. So the loan amount is 75,000. Let's just say for round numbers, the closing costs are 5,000. So 70 grand is what's left. That's going to be what goes to repay 70 of the 75,000 that you borrowed on those lines of credit. Remember that $5,000 differential there is going to remain that you have to pay off. You're just going to use probably the passive income of the property to pay that off, ideally before interest starts accruing on it. And even if it doesn't, fine. But also, we're going to have to count or calculate what the payment on that $5,000 will be, and it will have to be included in your debt to income ratio. Okay, so that's a little bit more complicated, but that would be another way that if your particular issue and breaking into real estate investing is not having the capital, that would be one way that you could attack it. I'll pause there. Larry, you said we have a question?
Just for a couple of things, Seed Capital. So I know this was mentioned on last show, Caeli, for Seed Capital. For those that need contact information, when we push this out after the show, we'll make sure that everybody gets the contact information for Seed on that zero. We did have a question from our pal Eddie. Eddie's asking a really important question. Again, we've seen this a little bit recently with some borrowers where they're maxing out their qualifying debt to income. And so is that a time where you turn to non-recourse loans, Caeli, or do you change your strategy if you know from a qualifying perspective, you just don't have enough income to qualify for a new loan? How would you handle that?
So I would want to look at why they think they're maxed out. Okay. And depending on where we are in the year, this is going to be important, right? If we're coming on the end of a calendar year or tax year and about to get into a new year, that may not be applicable anymore, right? We're always pumping the same philosophy. Don't file federal tax returns until we've reviewed them first, especially if you're an investor with multiple properties, because we want to review your Schedule E. We want to make sure, one, you have all the right deductions in there. I just looked at a Schedule E today for a client, and his CPA missed putting in the deduction on 5 of his rentals. The taxes weren't there. 4 of his rentals didn't have the insurance being claimed on there. And ultimately that hurt him, right? His debt to income ratio would have been less if he would have claimed those things because they're add backs. I won't go into the math of why, but it ultimately hurt his overall DTI. Now he was still able to qualify, but what if he was right on that ledge, that precipice that said, you know, if you would have put these things in here, you would have been at 45. Now you're at 52. I can't get you to qualify conventionally. We do then have to look at other products, which I'll get to in just a second. So thinking that your debt to income ratio is at that mark or beyond, let's double check. We want to exhaust the possibilities and make sure that we are ensuring we're qualifying you for the best products and terms and rates and all of that stuff. And then beyond that, I think one of the real great things about us as a company is that we are not that one size fits all. We have tons and tons of options for our investors, notwithstanding the Fannie Freddies. I mean, that's probably a smaller part. Then we've got our debt service ratio, our non-QM, bank statement products, asset depletion products. There's so many different product types that we can consider. It's highly unlikely. In fact, I can maybe think on one hand over 25 years of clients that have come to us needing financing that we absolutely had no options for. It's very, very rare. Now, the options that we do have, what I mean when I say that is that almost 100% certainty we can get you a loan based on whatever your issues are, your criteria is. Whether or not the terms of that loan make sense for that property, we won't know until we look at it together. But so DTI is a lot less of an issue in terms of the securing of funding. We will have a loan for you, but let's just make sure we know what we're dealing with now, or as we continue to move in the year. Let's look at how the properties have been performing. Let's check those draft Schedule Es. Let's plant those seeds and make sure that we are preparing you for what the best product is for that property for that time.
So Caeli, when you're going through, and again, we've gone over assets, right? And we've gone over a plan. One of the things that you mentioned earlier was credit. And I've seen a couple of times where we've rescored somebody to help qualify. Do you want to speak to that a little bit more?
Sure. So first of all, there's things that we can advise organically without having to go through what a rapid rescore would entail, which isn't really that big of a deal. I'll get to that. But here's some of the optimization things that I just share with our clients that maybe we haven't pulled a credit report yet. And by no means am I any credit expert, okay? I've just been around long enough. I know some of the tricks. So, you know, if you want an expert, you need to find a credit expert. But for optimization of scoring, it is my understanding that you want to keep revolving accounts, your credit card accounts, to 4 or less, no more than 4. You really don't want department store cards. There's something about the algorithms within the repositories, TransUnion, Experian, and Equifax. You guys know those names, right? Those are repositories. And department stores, there's something in there that I think affects the score to a negative. So ideally, you want to just have the regular credit cards, no more than 4, and the utilization. This is a big one for credit scoring. So utilization means that you've got a limit, a credit card limit, and you have a balance. You want to keep that limit and the balance to 30% or less. That's optimal. 40% is good, even up to 50% still good. When you start going over 50% in utilization, that's when the score really starts to take a hit, is been my observations. Now, one of the things that you can do to kind of trick the system, if you don't have a ton of cash, for example, to throw at credit card debt right now, if you have a long-standing good relationship with the institution that's providing the credit, you can go to them and say, okay, Chase or Citi or whoever it is, I would like you to raise my credit limit. I would like you to raise my credit limit so that now we're kind of tricking the system to have it appear as if you've got that lower utilization. Obviously, if you raise the credit limit, you can't charge anything else on it. Okay, that goes without saying, but that would be one way that you can kind of boost a score. Some people are starting to use the, what is it? Somebody tell me, the utilities, right? It's called something. One of the repositories has a means that you can have your electricity bill on there, your phone on there, different things like that. And it should show that payment history if you're lacking, right? If one of your issues is you're lacking in history of credit, you can throw those things on there and it'll show that you've got 24, 36 months of perfect payments, right? So that can help you score.
Credit boost?
Maybe, yeah, maybe that's what it
Like
is.
that? Okay.
There was a minute, I'll tell you, in underwriting, there was a minute where we were hitting the individuals with those payments when they showed up. I think Fannie Freddie quickly saw the error in their ways there, and we eliminate those payments now because they aren't part of debt to income ratio normally. So we can back those out of the DTI. Collections and judgments, right? Late payments, all of those things. I mean, I could go on about credit and kind of the inner workings, but those are some good little nuggets, I think. What's next?
So we've got going back to the DTI question. And again, this is specific to Eddie. So Eddie, thank you very much for sharing your story with the team here. So the question reads, he's got 5 properties under contract in the last 6 weeks. And at the beginning, it was the loan files were started with the income and revenue of with the income of him and the revenue of the property for the first 2. Then the lender told him that we have to shift to a commercial loan. Again, it's really specific. So Eddie, do you want to, I don't know if you can speak to this, but switching to a commercial loan is typically a function of the property, isn't it, Caeli? Not necessarily qualifying.
Well, so I think what's happening is that, Eddie, they're probably not giving you credit for the rental income the way that maybe they should or they could. And if there's a reason that they couldn't give it to you, what they're saying is that, yeah, we're going to take this from a debt to income ratio calculation and we're going to move it into more of a commercial calculation where it's debt service coverage, where it really is the rents divided by the expenses of the property. So chances are, again, they should be giving you some percentage of the rents of the properties. Now, where it gets a little bit sticky is that if in your case, you've got 5 properties under contract all at one time, if 0 of them are rented, right, there's going to be some difficulty because the subject property, and there's only one subject property at a time. So all 5 properties are being disclosed, but only one of them is going to be considered the subject property. That property is going to get the benefit of up to 75% of the gross rents that will be gleaned from the appraisal. Okay, so that one's covered. But properties 2, 3, 4, and 5 they're not the subject property, right? They're not in focal point, but they're still part of the disclosure, right? They're still in the mix. They don't have lease agreements. If they did have lease agreements, they should be giving you the rents. So maybe what you need to do is you need to sequence this appropriately and tell the seller that you can't close, or we sequence the closings until some of these have leases. Now, here's another important nugget. The lease only needs to be dated from 30 days after our close date, right? The tenant doesn't have to be in there or have a lease signed prior to closing. As long as the lease is dated within 30 days of our close date, we can use that lease. So for example, let's say we were closing today, the 28th of June, as long as the leases on any of those were dated between today and July 28th, I can use them. So I would want to have another conversation with you and just really kind of understand exactly, unless any of this makes sense, feel free to comment, Eddie.
Okay, yeah, that's very helpful. Thank you, Caeli. Yeah, you're absolutely right. 2 of the property has a leases and the other 3 were not.
Okay.
So, yeah, I mean, but the technique you just shared, or the strategy you just shared, that as long as it has a leases, even if it's for the 30 days period, there is a way to calculate some revenue from that property. I did not know that, and my lender did not share any of that information with me as well. So, yeah, unfortunately, we were kind of in. I was trying to secure the loan before the last rate jump take effect, and we just went out and put the loan on the commercial loan product for 30% down and a little bit higher rate.
Okay.
So that's where we are.
Well,
not
I would
just-
say my first question is, what are you doing cheating on me? Okay, that's my first
It's
question.
New York. It's New York. It's New York.
Oh, no, it's New York. Okay, that's why, because we can't do New York. That makes perfect sense, then, Eddie. You're forgiven.
Okay.
So
Thank
then what I would suggest is maybe we can have a conversation offline here, and I can take a look at it with you.
Okay.
My instinct is that if they don't know that they're allowed to do this, maybe they're just not up to date with the guidelines, or it could be, unfortunately, it could be what we call an overlay. So an overlay is above and beyond what the real baseline qualifications that Fannie Freddie allow.
Okay.
And it's layers of risk. They're going to say, it doesn't matter, we're not going to let you do that. I would be surprised though. So if you want to have a quick conversation this week, what is it closing now? I mean, you're already past the point of no return, or what?
I wouldn't say no. I wouldn't say no. We just secure. He just gave me the commit. The broker just gave me a commitment
Okay.
for those. Maybe about a week ago.
Well, why don't we do this? Why don't we, you and I can quickly talk, but why don't we do a conference call, the three of us, whoever your loan officer is, and I'll just let them know that, I'm your cousin in the States, and I'm in the mortgage industry, and I'm going through it, and I have got some questions, and we can figure it out.
I would love that.
Yeah.
Excellent.
Okay.
Very
Okay.
good.
Good.
Thank you.
You bet.
Thank you very much,
You
Eddie. Nancy, to answer your question about lending products at Ridge. So Caeli, because there's so many different lending products, and somebody's like, well, which lending products do you do? I mean, how do you typically answer that question?
I'll give you the basics, and then we can do a deep dive in any or all of them. So everybody knows we've got the conventional, the Fannie Freddies. Okay, 10 of these per qualified individual. More often than not, people really want to maximize those first. However, I'll tell you, as interest rates are rising, the ARMs, the adjustable rate mortgages, currently, this is at 1:57 Pacific time on Tuesday, the 28th. Okay, be ready for this to change at a moment's notice. But as it stands today, conventionally speaking, the adjustable rate mortgages are not pricing better than the fixed yet. I think that that's going to change soon, but as it stands today, Fannie Freddie stuff is 30-year fixed. Okay. However, we do now have products that are adjustable rate mortgages, interest only, that are available, that we are finding we're going to start shifting quite a bit more of our closings to those types of mortgages. One, because I'm a fan of an ARM. We can go into why again, for those of you that I think we talked about it last week. I'm also a fan of the interest only. But the cash flow is starting to change, right, guys? I mean, any of us that on this call that thought that we would be living like, hogs in the fat house forever, that's naive, right? We knew that the tides would turn a little bit. So as investors, we have to be prepared to pivot. The 30-year fixed, if you have your head absolutely wrapped around that, I may try to argue with you for a minute because I just don't think that's going to be to your advantage. I'll share with you why. Aside from that, let's start looking at the adjustables and the interest onlys to keep as much of that cash flow as we can. I promise you, you're not going to keep the 30-year fixed mortgage for 30 years. And if I'm wrong, then I'll eat my words.
But you got to stick around for 30 years to find out.
Yeah, that's right.
I think ultimately, Caeli, we probably go out of our way not to try to put everything on, at everyone's fingertips, because the loan programs and guidelines especially just change without notice.
They do. And thank you for bringing me back, circling that back. So conventional, you've got non-QM. QM stands for qualified mortgage. A qualified mortgage is the definition of Fannie Freddie. That's what a qualified mortgage is. So everything outside of that now is kind of deemed non-QM. Non-QM is a very diverse product line, and it's not just for investors. Owner occupied, second home. If you can't fit into that box, this is where you're going to live for, you still want more of an institutional loan. 30-year fixed is still available here. It's got debt service ratio products inside of it. It's got bank statements where you can look at 12 or 24 months worth of bank statement deposits and divide by that number. Asset depletion, right? There's a ton of things inside non-QM. Jumbo loan products are going to be in there. Then we have more of a commercial based where it's really going to be about the property. Okay. Debt service coverage ratio as well. but it's going to close in the LLC name, the entity name, and you're going to hold title in the entity name. Recourse and non-recourse is available for that. The ARMs and the interest only is also part of that product line. So there's that. This can also be cross collateralization for those of you that have multiple properties that you want to blanket into one, or you want to purchase a package of properties. Up to 10 is what we allow in this one cross collateralization. 5, 7, or 10-year ARMs, interest only. We have bridge loans for those of you that are looking to do rehab, fix and flip kind of stuff. And then we have true commercial, right? Maybe you're buying a 20-unit apartment complex, or maybe you're buying a storage unit. I don't know, whatever it may be. And then we have the all-in-one. So I think I covered them. Conventional, non-QM are commercial for residential, true commercial, and the all-in-one, right? I think that's the round out
I think that's generally speaking. And
yeah.
I think sometimes we get lost in the program versus everything that it can support. So if anyone has any questions as a follow-up on any of these programs, et cetera, certainly can post a question on the community. Pardon me, you can always call in to 855-74-RIDGE, or you can always email in at info@ridgelendinggroup.com. Before we get too deep, talking about one of the loan programs that you mentioned at the ARMs, interest only came up as a question, Caeli. Either pros and cons of an interest only on an investment property.
I like an interest only for a variety of reasons. One, it's really going to help with your cash flow. And to be honest with you, let's break this down a little bit. My friend Axel is on the call. I'm sure would love to chime in here. He'll probably have some tips for us too. But here's how I would present the interest only. So let's look at a 30-year fix first, okay? And we've already established that the percentage of mortgages that last from your first payment to 360 payments later is less than 1% of the population. And for investment properties, it's probably a fraction of a percent, okay? That start here and end there. It just does not happen. The other thing that should be important to comment here is that the first 10 years of any 30-year fixed amortized loan, how much of principal do you think you're paying? This much. 95% of your payments are going straight to interest. They want that interest. You don't even start plunking down the principal until later on within the term of the loan. They want to ensure that they get as much of their interest as possible. So for those reasons, let's go back to our all-in-one and think that through. Or not our all-in-one, an interest only, all-in-one is interest only as well, but an interest only loan, and think that through. So if you wanted to, you could actually accelerate the payoff of a mortgage faster with an interest only than you ever could with a 30-year fixed, if you wanted to. I'm not saying that that's the scenario. Maybe it is for the property, maybe it is for your station in life, right? Maybe you're into your 70s and you're starting to accelerate payoff, whatever it is. This is very subjective to the individual, but the interest only right now, especially as we see interest rates increasing, is going to save you in cash flow and allow you to continue to have that cash flow. You're going to stockpile for down payments. You're going to be using it for your living expenses, maybe whatever your circumstances are, it doesn't really matter. The interest only is going to provide the best of all worlds. Big fan of the interest only, because you're not going to keep that loan probably longer than 5-6 years, certainly not longer than 10. And if I'm wrong, then fine, don't get an interest only on that property if you know for sure it's going to last that long. Otherwise, the interest only is definitely the way to go. The reason that we haven't been using interest only up until literally right now, recently, they haven't been available. That's not true. They've been available, but their interest rates have been so high for the function of the interest only that it completely removes the benefit of what interest only is supposed to do. So for example, if your 30-year fix is at 5%, but your interest only is at 9%, right? There's the benefit's not there. If they're within the same range of rate, or maybe even a little bit lower on the interest only, if that's where rates are, then you're going to see some huge benefits. remember you guys, I was on a podcast recently, and I've been doing a lot of these lately, so I don't remember exactly which one. But it's so important to do the math. Maybe it was here with you guys in the community. You have to do the math. You're not going to know unless you're doing the math. Don't just assume that interest only is a bad thing, or an ARM is a bad thing. I heard somebody tell me last week, because ARMs are now more back in the mainstream, we're starting to hear them come alive again, that the bad boy loans are now back. Okay, let me dispel let's just talk about what a bad boy loan is. Okay, an adjustable rate mortgage is not a bad boy loan. A bad boy loan was the lenders that were doing 100% loan to value on a stated income basis for investors. They didn't have to show any income. And this wasn't a debt service ratio loan. This wasn't where they were looking at the property. It was just a stated income loan. They had stated income, stated asset with zero down. They had loans at 105% LTV so that your closing costs could be covered within the thing. They had neg am loans where you were adding to your principal every month up to 125% of the value of the home before that you have to start actually making a payment to bring principal down. Those are bad boy loans, you guys. An adjustable rate mortgage is not a bad boy loan. Anyway, I'm a little passionate about that subject, I guess.
Just a little. So
does that answer your question? Did I forgot the question?
I think no. I think we nailed it. Really, it was just about some pros and pitfalls of the interest only. Lots of pros. Is there a downside to an interest only to you?
Well, you're not paying any principal, but so what?
No, I was thinking maybe interest only loans maybe limit your qualifying because of maybe the loan to values are a little bit different, or the qualifications are a little bit more stringent.
So the loan to values are the same. In fact, they're allowing for higher on the products that we're using for the interest only. Let's let you go full 80% regardless of transaction type or property type. So cash out, rate and term, purchase, and 2 to 4, all of those things can all go to 80%. Whereas on a more conventional basis, you guys know that a cash out has slightly lower LTV. A 2 to 4 unit has an even lower LTV, right? The leveraging starts to go down. Whereas on the interest only and the ARM products, it's just a straight 80 across the board. In terms of qualifying, that's probably a good point. I believe that for not in this case though, let me just say, if Fannie Freddie bring back ARMs, the qualifying is going to be, and I just talked to Marta's here, I think, Director of Ops, and she double checked too. So it will be, qualifying is going to take 2% over the fully indexed rate is what we expect when Fannie Freddie, or if Fannie Freddie brings these back. So if your fully indexed rate, index margin added together, if that was 5%, for example, we're going to qualify you assuming 7%. So qualifying in that way might be a little bit more difficult. However, on the products that we're using right now today, not Fannie Freddie, the adjustables, 5, 7, 10 years interest only, they're just using the note rate. There's not a qualifying above and beyond that. And that's a debt service anyway, so it wouldn't matter.
Okay. Thank you very much. We did have a question come in, and this kind of speaks to the topic of today's meeting, which is building up real estate investment portfolios. So this question comes in from Michael and Tracy, and I imagine you're probably going to see this come up quite a bit in the coming years. The situation is as follows. My interest rates are low and the properties have equity. So what are your thoughts, Caeli, on how they can tap into their equity in a smart way to fund additional purchases?
So I would say, and you guys are I'm beating a dead horse here, but you need to do the math. Okay, so I would say that we want to look at your portfolio, and on a property basis, not the whole thing, I would go property by property and individualize it and say, okay, is a cash out refinance, full cash out refinance make more sense for this one, or maybe looking at a second lien HELOC better for this one, or maybe an all-in-one for that one. I think it really depends on a per property basis, what the rate is, how long you've had the loan, what the cash flow is, how often you're appreciating your rents, what markets are they in, and then what are your goals, right? How far are you from reaching your first benchmark of hitting 10,000 a month or whatever it is? How far are you from that? How much further do we have to go? So really individual, and we want to break it down and really peel back the layers so that I can answer that more specifically. So where did that question come from?
That was Michael and Tracy.
Hi, guys. Yeah, I would say that we want to schedule a call and really, I feel like Michael and Tracy, if you guys have gone through our pre-qual process, I feel like we probably have your REO on file, and we could easily spend 20 minutes on the phone and just dig into that.
Do you find, Caeli, on that topic of Michael, thank you for, or Tracy, both of you, thanks for jumping on the scheduling. You know, I feel like that ties into the reason why Ridge Lending Group created the certified power buyer program, was to really look at their overall portfolio and build a forward-looking strategy. Is that your thought on that?
Yeah, I think that Larry and I discovered this together, actually, and it wasn't something that I didn't already know, but I didn't realize it was as much of a demand or a desire for people to really have someone on the inside that kind of has an inside track, helping them establish a plan, right? I want to buy real estate. Everybody that we talk to, that has been defined. We know that that's what they want to do, but getting there and what the steps are to get there isn't always as clear. And for me, I just assume, you've done your research, you know what's happening, but that's not the case. That's not fair. I live and eat and breathe and sleep this stuff, and I've been doing it for 25 years. So Larry and I came up with the certified power buyer. This is a way that I can myself personally can connect with our clients and take them through a pre-qual process that happens first. And then we get back together and really develop that plan that fits with, I started talking about this, that really fits with where they are today, where they want to be, their long-term goals. And we create a lane, right? And we're going to pivot here and there. Things are going to change over time. That's fine. But we can really specifically create that detail so that they know this is what I want to try to do this year. And they check off the wins in the win boxes in the win column, and they move forward. It's really, once you're able to kind of see it from that perspective up here, it's really not as complicated or as intimidating as it may seem. And then in the end, you've got your support team here that's keeping an eye on it for you anyway, right? We're keeping an eye on that Schedule E. We're keeping an eye on that credit score. As long as the communication is good, we know how to prepare for what's coming next and next, right? As long as we know what your plans are throughout any given calendar year, we are in the background making sure that we're updating certain things, like I said, like your credit score, or preparing you for assets that you may need going forward. We have our clients emailing and calling us, hey, I want to buy a new car. What does that look like? We know these people intimately. We're not transactional. And I'm not trying to pat myself on the back, but it's not like calling a Rocket Mortgage and asking that question. I don't even know if they could answer that. You call us, we know you, we get your profile up, and we're having an answer for you within, an hour, maybe 24 hours. I don't know how much of my team is on here listening to me say that, but we'll have an answer for you quickly. And you don't have to worry that you're making a bad move or a wrong move that's going to otherwise derail you from qualification.
Awesome. I did want to again recommend, as we're drawing along on the meeting here, if you have any final questions, please put them in chat. We do have two. I do want to get to two questions I think are important. Teresa wants to pull you back, Caeli, to a comment you said earlier. We were talking about the interest onlys, and the idea of buying an investment property using an interest only, and because you're not paying down the principal of the interest only loan, there's a concern about having sufficient equity in the property when they're ready to sell or do a 1031 exchange. Does that tie into any concerns about the interest only?
Not for me, and let's explore that, Teresa. Thank you for your question. So remember, if let's just say it's a 5-year trajectory or a 7-year trajectory, what I want you to do is I want you to look at an amortization table of a 30-year fixed and whatever that interest rate is. Okay. And at the 7-year mark, I want you to look and see how much principal you've paid down. The appreciation is going to be the appreciation is going to be the appreciation. It has nothing to do with the loan product that you've secured. Okay. So after 7 years, figure out how much principal you paid down. I think you're going to be surprised. It's a much smaller number than you think. But what have you been doing on the backside of this for 7 years? You've been cash flowing a significant amount, such that perhaps, or significantly more amount than you would with a principal and interest. And depending on what you're doing with that capital, are you stockpiling it for another investment? and that's pretty common, let's just say that that's what you're doing, then what you've done over 7 years is you've taken some of that cash flow and maybe you've gotten another property, maybe you've gotten 2 more properties in that amount of time. So the 1031 exchange and what you might be missing here in that small amount of principal that you've paid down over 7 years time. Now, if you are absolutely positive you're going to have that mortgage, that principal and interest mortgage for 10 or 15 years, okay, maybe that's another conversation. It's highly unlikely, but if you know for sure, then sure, then I would reverse my comments and say maybe the interest only isn't going to be as profound. Or maybe we take an interest only and we can use the cash flow and accelerate the pay down of the principal faster if you wanted to. Again, it's very subjective to the individual's goals and qualifications and needs.
Awesome, Caeli. Thank you very much. And we'll focus on one more question here, and then we'll do some wrap up to get everybody along with their day. Again, if you ever want to come back and listen to any part of this, we'll be posting the replay on the Ridge Lending Group community soon. Usually takes a couple days at most. So this is a question from Victoria, Caeli, and the question is about a specific situation. Do you have any thoughts, feedback on when she's coming across a deal that's in front of her? The plan is to use hard money, so private lender, because there's a substantial amount of value being added to the deal once the deal is secured. Any concerns, any thoughts if you know you're using non-conventional financing as far as getting in and moving that financing? Because usually hard money is usually not very long term.
And it's going to be expensive. So what's the exit strategy, Victoria? Are you, yeah, go.
So essentially what I've found is it's a property that has primary residence on it. It's zoned R5, which means, I can basically put a duplex on it. And obviously I'm not going to put a duplex on the lot that has the primary home on it. I'm going to just add value to that. But in the purchase, there is a lot next door that is also zoned R5 and has nothing on it. So I'm planning on adding a duplex. I'm going to rent out the primary residence while the duplexes are being built on the secondary lot, and then transition those tenants over to the duplexes once they're complete to help mitigate the cost of the interest only payments month to month.
Mm-hmm.
But I'm just, I've had some of my investors that I work with, they're like, oh, go in with a new construction loan. There's a primary dwelling on the property, but because you're basically building on the other lot, you can still do it under a new construction loan. But then I have the hurdle of, well, you don't have new construction experience, so that's not going to be ideal. Just purchase it like you're basically purchasing a property and you're going to do an ADU or an income generating unit on that property.
Mm-hmm.
So it's just an expensive deal. ARV is looking like 3.5, purchase 1.7, but the rental income is exponential.
So what's the term of the hard money loan that you're getting? Is it 12 months, 24 months? How long will you have access to that money?
So I can do up to 12 months. And I would be paying about 2 points, 9% interest.
And they can probably roll the interest into the payoff at the end, right?
Yes.
How long will it take to build the property?
So what I was planning on doing is having an architect do a collaboration with a prefabricator who basically would take the plans and just to limit the time, try to cap it at 6 months. But the hurdle that I'm really coming up against, because we all know, you can figure out, it's just like getting the architect, getting the builder. Starting as an investor in this way, it's like people that do this, they have teams. They have people that run when they call and, go and assess and talk about the potential of the property. And I'm like shaking in my boots. Because what if I go under contract, I purchase this property, close in 7 days, and then they say, oh, you can only put 1 unit.
Yeah.
on the lot, even
Yeah,
though
you
it's
definitely want to have your ducks in a row. It's going to be like turning a battleship in a creek, Victoria. So I applaud you for the ambition, but I think that the hard money loan in this scenario would be fine. Pay the freaking money. If you can have the interest payments added to the loan, you think it's going to appraise for much higher. Give it a year, then you refinance, do maybe a rate and term or a cash out. If that's the case, the property is stabilized. You can show the rent rolls. That's probably how I would, I probably don't have all the details, but that's probably how I would structure it. 9% and 2 points on what you're telling me. I don't think that's a big deal.
Yeah, and I mean, I saw someone in the comments that get the hard money for the construction after permits have been received and get regular financing for the existing property. And I think that's a good point. Like, I'm so versed with hard money, but I have almost no knowledge. Like, I've never purchased a primary residence. I've always been a renter. It's just what I've preferred.
Mhm.
So I'm curious about your take on that. Maybe some other people could gain something from that. If I, haven't already utilized my conventional financing methods, would that be potentially intelligent or no?
And just use the hard money on the, well, will the hard money do a ground up construction?
I'm sure that I could find someone to go in on it as in a joint venture sort of way that maybe has builder experience so that I could get approved perhaps. Um, I have lenders that do new construction hard money loans. So I mean, I'm sure I could find someone. I've just never considered not going in with hard money because I'm so aligned with the concept of leverage and spreading my risk and, keeping as much cash in my pocket as possible.
I would say then, again, not to continue to say the same thing
Sorry.
over and over. Let's do the math. Let's see how, and first of all, qualifications, right? What are the qualifications? And then let's break them up. Let's see what happens if we do this conventionally or more. It sounds like it's going to be, I think I remember talking to you. This is Georgia, right, Victoria?
Yeah.
Yeah.
Mhm.
I think that we're going to be on a non-QM basis. I don't know if conventionally that's going to go, but an owner occupied, longer term, not hard money on a non-QM basis might be feasible.
Right.
I
Okay.
think cost wise, I just feel like if you break it up and then refinance it later, paying 2 sets,
It's like a lot of fees.
it is, for brain damage, just the few minutes we've been talking about this, I would probably go for the hard money, wait the year and refinance it.
Right. I'm with you. All right.
Thank you very much, Victoria.
Thank you,
And I
guys.
think that's kind of like the idea here, right? These things get very, very complicated and different opportunities can get muddled as you try to go back and forth. So I know we're always talking about when we're working with clients, right, Caeli, is make sure we write everything down, put it in a convenient way to look back to, and most importantly, try to plan for the worst. It's very easy to do things when things are easy, but what are you going to do if you do get stuck and you're in that construction? Now where do you turn? And it's not done. So
Have some exit strategies for
definitely
sure.
going to have some exit strategies. So for those that are just typing in questions, what we'd like to do is I'd like to keep the questions coming. This might be a great opportunity for us to connect next Tuesday and continue it. For those, if those that have joined today and you want to keep this kind of conversation going, we haven't done an exclusive open Q&A, but perhaps maybe it's about that time. Next week is July 4th weekend, so we'll have to see if we do this on July 5th. But if not, I'm sure it will be the week after. Closing comments, Caeli, in terms of making sure that, when somebody's thinking about reviewing the real estate portfolio and ideas to make it grow, what would you say to them in 10 words or less?
Call me.
There you go.
Call me or email me and let's see where you are in our process. And if you haven't started, we're going to get you started and then we'll just do some one-on-one. It's actually kind of fun. I think that the value add there is one, the education, but two, having somebody that understands and that you can trust is helping you create the long-term goals, wealth, freedom, whatever it is that you're after is in your corner. Call me, email me.
And so you can always call Caeli and team 855-74-RIDGE. You can always email info@ridgelendinggroup.com. If you want to sit down and go through the certified power buyer program with Caeli, there's actually a link on ridgelendinggroup.com to go ahead and start that process. It's just a few questions long to get that first interview set up. And Caeli, thanks as always for helping foster this conversation. And to everybody in the group, thank you very much for coming. We really appreciate your willingness to want to learn. So have a great
Thanks,
day,
Caeli.
everybody. Be well.
See you
Thanks,
soon.
everyone.
Take care. Bye-bye.
Bye.
Bye.